Hi, I'm Kandie Frederick with Country Real Estate. There's been a lot of buzz about the Fed's recent rate cut. What does it mean for mortgage interest rates? Will homebuyers or people looking to refinance see real relief? Today, I'm going to break it down in a way that makes sense and help you know what to watch for. Number one, the Fed cut rates, but that doesn't mean mortgage rates automatically drop. The Fed recently lowered its benchmark rate by 0.25%, aiming to support the economy. But the mortgage rates don't follow the Fed rate directly. They're more influenced by bond markets, inflation expectations, and investor behavior. Number two, mortgage rates have dropped slightly, but don't expect a huge dip very soon. Markets often price in Fed decisions ahead of time. That means rates started dropping before the actual cut, in anticipation of the change. So far, the 30-year rate has dipped modestly into the low sixes, but other factors like inflation and long-term bond yields still control the pace of the change. Number three, what you should do now as a buyer or homeowner. If you're thinking of refinancing, this might be a smart window to act. If you're buying, small rate drops can still improve affordability. Watch for future Fed moves, inflation data, and market trends. They'll all affect what rates do next. As always, if the payment is comfortable, it's the right time to buy. So, in short, the Fed's rate cut is a positive sign and has led to some easing in mortgage rates, but it's not the final answer. Mortgage rates depend heavily on long-term interest rates, inflation expectations, and lender behavior. If things go right, meaning inflation comes down and markets calm, then there could be more relief ahead. If not, it might be more of a gradual process. Either way, real estate investments are always positive in the long run. Reach out if you want to talk about your next real estate moves. Thanks for listening.